Hello everyone, today's vlog is all about expats, tax situations, things you need to know about if you are an expat, whether or not you are leaving the UK or returning to the UK. So within this global pandemic, unfortunately, a lot of expats are coming home, have lost their jobs, so they're coming back to the UK. But also we're hearing about more and more countries offering opportunities for people to become expats, giving favourable treatment, particularly places like Barbados and now Dubai, where they are saying to people, you can come and work in our territory. In some cases, you don't have to be employed by a local over there. You can work for a UK employer or an employer anywhere else, but live in those territories. So traffic going both ways in the expat world. So let's start off with expats leaving the UK. So what do you need to think about when you leave the UK? Well, the first thing is income tax, and will you break UK residency? Because what you don't want is to go abroad and basically be paying tax twice on the same earnings. So you've got a job somewhere overseas, you are resident in the foreign jurisdiction, but you haven't broken residency in the UK. So you need to consider what is known as the statutory residence test in the UK, which is a prescriptive list of rules to see if you break UK residency, then you'll only be subject to tax in the overseas jurisdiction, which is obviously what you want, particularly if you go into a low tax jurisdiction like the Middle East or some places in the Caribbean. So no UK tax and no overseas tax either. That's one of the reasons that I would suggest many people choose to live in those places and be an expat. Now, what if you don't break UK residency, but you're also a resident somewhere else? So you can be resident in two countries at the same time for tax purposes. Thankfully, the UK has a network of double tax treaties with over 200 countries across the world, and there is normally what's called a residency tiebreaker clause within the double tax treaty, which says which country has taxing rights. So you don't actually pay tax twice. You will pay it. You will pay it once in the primary taxing jurisdiction, and you will only pay it in the other jurisdiction if the rate of tax is greater. So, for example, if you didn't break UK residency and you were normally a 40% tax rate in the UK and you paid 25% in the new country that you've moved to, you wouldn't pay two lots of tax. You would only pay maximum 40% that you would have done in the UK, because you'd have first dibs in the new country, 25%, and then the UK tax authority would only charge you the additional 15%. So you would never pay more than you would have done if you hadn't have left the UK, unless, of course, the country where you end up has a higher rate of tax than the UK. But I suggest that that is typically not the case in many places, but it could be. But the point is that there is this mechanism for double tax relief, whereby you will get credit for any tax suffered elsewhere. So income tax, residency, that's the first thing to consider. Second thing is social security. So often when you leave the UK and work somewhere in the EU, there is a reciprocal arrangement with the territory with regards to social security. So contributions made by your employer into the social security system to accrue credits for the UK state pension. That could all change once we come out of the EU with Brexit. But at the moment, there are certain rules on maintaining contributions to the UK social security system even when you've left the UK. What about property? Now, property is quite a big deal. A lot of expats will go abroad and hang on to a UK property. If you are renting it out, then the double tax treaty, the way it works is it says that the UK has first taxing rights on the UK property. So you need to check what the tax rules are in the country of residency that you've moved to. Will they also want dibs on the UK rental receipts? Hopefully they won't. But certainly in most tax treaties, the UK has first dibs on that because of the situation of the property is in the UK. So if you have to pay UK income tax on your rental property, even though you're living overseas, thankfully, remember, you still have the personal allowance. Personal allowance, 12,500 this year, 2021 tax year. And as a British citizen, even though you may be non-resident, you still have the personal allowance. So thankfully, if you did have buy-to-let profits that were subject to tax, the first 12,500 is covered by your personal allowance. But you do still need to do a UK tax return to declare that income. There's also a thing called the non-residence landlord scheme, where the agent withholds tax. You can choose not to do that and instead do a tax return, put it all down, and then hopefully pay no tax because it's covered by your personal allowance as a British citizen. What about capital gains tax on the buy-to-let properties and capital gains tax generally? Rules have recently changed. It used to be the case that you used to live abroad for 5 years and you would escape UK capital gains tax. However, that has changed. So now UK CGT applies to non-residents. So you sell your buy-to-let property in the UK, even though you're living in Dubai, that will be subject to UK capital gains tax. Okay, what about inheritance tax? Now, inheritance tax doesn't turn on residency like income tax and capital gains tax does. Inheritance tax turns on a concept called domicile. Domicile is a more permanent thing than residency. Residency can chop and change year on year, but domicile is pretty much fixed. It's quite difficult to dislodge a domicile. However, it's not impossible. But the point is, even though you are non-resident in the UK, the UK tax authorities may still consider you to be UK domiciled for inheritance tax purposes, which means that you may spend several years overseas, not come back, and potentially you could be subject to inheritance tax in the UK, even though you've been living overseas for many years. So have a think about IHT, certain things that you can do if you've lived abroad for a while, decided you're not coming back to the UK, certain things to change your domicile so that your inheritance tax bill is reduced when you do pass away. Pensions is another thing to consider. What about pension planning when you move overseas as an expat? What will you do with your existing UK pension? Will you transfer it abroad to an overseas pension and then continue to contribute to that pension from overseas? There are several types of transfer arrangement available that HMRC approve of, have all sorts of fancy sounding names like QROPS and QNUPS, qualifying registered overseas pension scheme, and various things like that. So have a think about your pension. What are you going to do when you become an expat? Should you transfer it? What are the tax implications if it's not one of these approved pensions from HMRC on HMRC's list that are based abroad? Will HMRC try and tax you on the transfer out of a UK pension? Actually, one of the good things about the QNUPS, which is a type of overseas pension, is that when you sign up for one of those and it's approved by HMRC, that actually then says that the pot within the QNUPS falls outside of the UK IHT net. So let's assume you haven't broken your UK domicile for inheritance tax, but you've got one of these specific types of overseas pension arrangements, then at least that part of your wealth does escape the UK taxman as far as IHT is concerned. So all sorts of things to think about when you're going away. But just to sum up, income tax, residency, social security, property rents, property capital gains tax, IHT, and pensions and overseas transfers. What about when you come back? I'd suggest it's pretty much all that in reverse. Timing of when you come back, splitting of the tax year. Again, we have this statutory residency test in the UK in terms of we can split the year. So it's basically part of the year you'll be non-resident, part of the year you'll be fully resident. But the timing is crucial because the overseas jurisdiction, they may not operate on a similar basis. So it could be that there is some overlap of double tax subject to the double tax treaty provisions, but it could be wise just to plan that properly, and it may be as simple as just delaying a return or accelerating a return a few weeks. What about when you come back but you have kept an overseas pension? Different rules apply to taxing overseas pension income when you are resident in the UK. So different than having a UK pension being based in the UK. If you're based in the UK and you've got an overseas pension, slightly different taxation rules on that. And then, of course, when you do return, you're straight back into the usual taxing regime for everything else, for capital gains tax and inheritance tax. So that is just a quick overview on tax implications for expats, both leaving the UK and coming back. If you like this video, please do subscribe up here, and I will see you soon.